Hi, folks. Welcome to today's Bob Benny Wealth Management webinar. I'm Bob Benny, Certified Financial Planner.
I'm Jessie Thompson. I'm a financial advisor.
So go ahead and why don't you tell them how to ask questions during today's webinar. So
the title of our webinar today is Strategies for Savvy Investors, and we're going to talk about fickle markets like we've seen so far this year, and especially here probably in the last couple of weeks. If you have any questions while we're going through everything, we'll answer all of those at the end. And the way that you can ask them is you have a chat box in the bottom of your screen. You can type your questions in. You can say your name or not. We won't say your name at the end when we go over all the questions. A few things that we'll be covering in this webinar are the reasons behind the volatility in the stock market so far this year, our outlook on the health of the economy and the companies on the stock market, what investors should and should not do during market downturns, and then also some strategies that nervous investors can take when they're feeling uneasy during market downturns as well.
So let's get started talking about market volatility. And you know, we've experienced a lot of market volatility. The stock market's gone down significantly this year, kind of gone down in an erratic way, goes down, then goes back up, and goes down some more. That's not, though, the biggest financial threat to everybody right now is their account values going down. The biggest financial threat to everybody, you and me and everybody watching this, and all Americans for that matter, is this hyperinflation that we're experiencing. This market downturn is irrational, and it's driven by fear and panic. And when people are panicking and there's more people selling than buying, the stock market goes down. And the reason I'm saying it's irrational is that you buy a company or companies based on their financial health and their financial performance. And the companies on the stock market are doing quite well, very well, with both their revenues and their profits. But the news media, particularly the financial news media and now the mainstream news media, is frankly full of leftists that are trying to drive the stock market down, trying to scare people to sell news, but they're also purposefully trying to drive the stock market down. And some people are buying it. Obviously, enough people are buying it that it's causing the stock market to go down. But we want to talk about our advice and what savvy investors should be doing at this time.
And we're going to sprinkle in some quotes from one particularly savvy investor that kind of thinks the way that we think. And it's not Elon Musk. It's actually Warren Buffett. And when I say he thinks the way we think, it's not politically, but he thinks the way that we think as investors, and the way that wise investors should think. And what's made Warren Buffett one of the top 10 wealthiest people in the world, and such a great investor, is that his philosophy on investing is value investing, which means he invests in companies that he believes are fundamentally valuable, and he tries to buy them at a discount. Like when the market's down, like right now, you can buy stuff at a discount. But he invests in companies that he believes are good, strong, valuable companies, and he doesn't worry about what everybody else on the stock market is doing as far as buying or selling, or what the trends are, or what the new hottest, maybe most popular company is. He invests in good, solid companies, and this goes on the belief that, you know, the stock markets might go up and down based on kind of people's emotions or a herd mentality.
Yeah, it's kind of fickle. The stock market by nature is fickle.
But that stocks will eventually reflect their accurate market value. And so we're going to sprinkle in kind of some quotes from him to make things interesting here as we go. But let's take a look at kind of some of the main drivers behind what's been in the news media and what's been driving this market volatility so far this year.
Well, it first started with the financial news media and then the mainstream media just towards the end of last year, talking about because of inflation, the Federal Reserve was going to raise interest rates, which the Federal Reserve rate was at 0. and they started touting that these interest rate increases are going to crash the stock market. And then they have also shifted to talking about the war in Ukraine and inflation. And now they're talking about a recession. But all these things haven't historically caused the stock market to go down and stay down. The fear of them can cause the stock market to go down a little bit, but then it recovers. But interest rates going from 0 to first 1/4 of 1%, and now they raised it another couple of weeks ago, another 0.5% to 0.75%. That's not going to hurt the profits of these companies that were the large companies, the S&P 500 type companies, the large NASDAQ companies. That small of an interest rate increase is not going to harm those companies. Most of those companies don't borrow money anyway. But a little trickle of an interest rate increase isn't going to harm them. So
we're gonna go through each of these, and since we're on interest rates, we'll go ahead and talk about those. The interest rate that just happened here a couple of weeks ago was a 0.5% interest rate increase, and there was a bunch of stuff in the news about that because that's the highest interest rate hike that we've seen since the year 2000. Well, to put that in perspective, in the year 2000, when interest rates were raised a 0.5 point, they were at 6% already. And they're almost at 0 right now. So they were raised from 6% to 6.5%. That's a lot bigger deal than going from almost 0 to now. I think throughout this year, it's almost 1%, but it was at about 0.5% before this latest interest rate increase. And also for some more perspective, the Fed projected that their median estimate for what they want interest rates to be for this year, I believe, is 1.9%. Still super, super low historically. And then the next 2 years, they said that their median interest rate goal is 2.8%. So they're not trying to historically raise interest rates back up to, something as high as 6%. And for a little bit more perspective, when inflation was at its very, very highest in the late 70s and early 80s, the federal funds rate, the interest rate that they were using at one point was 20%. And we're looking at, still at the most 3%. Right. And so something like that is not going to hurt the stock market. And historically, interest rate hike periods have not hurt the stock market either. And so let me show you this graph that we have here of the history of the S&P 500 during interest rate hike cycles. So the averaged annualized rate of return for the S&P 500 during interest rate hike cycles is 9.4%. That's really good. So historically, raising interest rates has not harmed the stock market. The next thing that we're going to talk about is inflation.
Inflation, and they've been talking about inflation, and we're having inflation. The inflation is real, of course. It's very high inflation, probably going to be over 10% for this year by the time we get to the end of the year, and that's significant. Everybody's experiencing it at the grocery store, particularly at the gas pump. But if you think about what the definition of inflation is the rising cost of goods and services, right? Rising cost of goods and services. That's why the stock market or companies are great hedges against inflation, because if you think about it logically, if you own the companies who are increasing their prices of their products and services, their value is going to go up with the inflation. So it's logical, but let's talk to them show them how historically that's borne out. This is a chart.
Well, this is a website that you can go to actually. If you ever want to run this, it's super interesting. But it shows you can plug in the years and it'll give you the stock market returns of the S&P 500 during that time. And then it'll show what they are adjusted for the inflation at that time. And so
I want to point out too, this calculator calculates with reinvested dividends. So you don't just look at what for instance, the index does. You have to count the reinvested dividends, because dividends are money that you're making too. Go ahead.
So we did this hypothetically between the years of 1974 and 1983. That's the highest years of consecutive inflation, that
highest 10-year
we've seen in history. At this point, there was inflation rates that were up to,
there were four years in that 10-year time period that were in double-digit inflation.
right,
And-
up to 13%, I think is what we
Right,
saw. Some of them
right.
were 11%. That's huge. So that's up 13% from the previous year that was 11%, one of those years.
Right.
It's crazy.
But the total return on the S&P 500 in that 10-year period was 10.75% or 10.73% per year. But when you adjust it for inflation, because people were losing buying power, it was still at 3.21%. So you maintained and increased your buying power a little bit if you stayed invested in large United States growth and value companies, which is what the S&P 500 index, the 500 largest companies on the New York Stock Exchange is during that time. So we believe that it's the best hedge against inflation is to be invested in the companies who are producing and selling the goods and services who are going up in price.
Another thing that's been in the news a lot lately, that's been talked about as a threat to the stock market, is the conflict between Russia and Ukraine. And so we're going to go over, we've shared this in a previous webinar, but we're going to go over really quick exactly how the stock market historically typically reacts to war and world conflicts. Usually right about the time that the conflict is happening and right before, with the tension and lead up to it, the stock market drops because of uncertainty and fear. But it's not long after that the stock market usually recovers.
We've got the Vietnam, going back to the Vietnam War, the Gulf War, Afghanistan, Iraq. Currently, obviously, we're in this, or we're not in it, sort of, but we have the Russian one. But war does not cause the stock market to collapse or go long. Generally, in the United States, war actually it's kind of bad to say, or sounds bad to say, but it's kind of healthy for the stock market. So the news media telling you that interest rates going up and inflation going up really high, and that the war in the war in Ukraine, between Ukraine and Russia, are going to collapse the stock market, is just a big fat lie, and it's just fear mongering. And we encourage you, don't buy into that fear.
And the last thing that we want to talk about is there's been a lot of talk in the media recently about the possibility of recession. And so we have another illustration up here that shows how the stock market typically performs before, during, and after recessions. And it's a little bit of a busy chart, so we don't, we're not going to go super far into it, but what we particularly want to pay attention to is that on average, stocks perform worse previous to the recession than during the recession. And then in the 2 years following the recession, returns are positive 82% of the time.
Yeah.
And it gets higher,
Yeah, if you go out on this chart, show them the column of 12 months after the recession, right there. The average return of the S&P 500 12 months after recession was 16%. It was positive 91% of the time. And then 2 years after recession, the average return of the stock market was 20% per year, and it was positive 82% of the time. So recession and the threat of recession is not going to collapse the stock market. The stock market's going to be fine, and it's a great place to be. And also, what they're calling a recession are usually relatively short-lived.
You can see that in this length column over here. Most of them are under a year. They're usually, on average, probably 6 months.
Yeah, or less.
The average of all these.
Right.
And yes, the returns are negative previous to and during, but they're very short-lived. And then right after, 6 months to a year to 2 years after, the returns are way higher than the negative returns that were experienced during.
Right.
So the stock market can recover from recessions, and they're short-lived. And so if that's something that happens, it's going to be okay for the stock market.
Right.
We do believe that the economy is still healthy, and we believe that the companies on the stock market are still healthy. And there's a couple statistics that we have to back.
All these publicly traded companies that are large, particularly, have professional stock market analysts from outside that are looking at them and looking at their books and their financials and stuff and projecting how that company's earnings going forward are going to go. And one of the things that we watch in our business is every quarter when these companies publish their actual earnings, one of the things you compare is how is their actual earnings compared to what the analysts were projecting them to be. And in January, of course, they announced their actual earnings for the last quarter of 2021, and the vast majority of just slightly under 80% of companies outperformed the analyst expectations then for the last quarter of 21. And then now, starting in April, companies have been reporting their actual earnings for the first quarter of 2022. And over 82% or 87% of the S&P 500 companies have already reported their earnings, and 79% of those companies outperformed what the analysts' expectations were. That's really good and should be really good for the stock market if everybody knew it. But people don't know that because that's not what the news media is selling. They're selling fear. And we're encouraging you, any of our clients or prospective clients or anybody that's watching this video, is don't buy into the fear because it's fake news.
Yeah, or one thing that they'll do is they won't report that most of the companies have exceeded expectations.
No.
They'll report one or two companies that fell behind expectations and say, look, see, this is how everybody is doing.
Yeah, the sky is falling, the sky is falling. So don't be Chicken Little. So
another positive economic news from April is that U.S. retail sales grew at 0.9%. That was more than expected. Industrial production in the United States doubled its expected rise in April, and it ended up being 1.1%. So in spite of the fact that inflation was the highest that it's been in 40 years in April, well, I guess that was in March. It was a little bit less in April, 8.3 or something, still super high. We still saw that production is good and people are still buying things.
People are still buying. That's right.
So,
still spending money.
Yep. And then lastly, the jobs report for April of 2022 was really good. We added 428,000 jobs to the economy. And what's really interesting is that the unemployment rate was at 3.6%. The last time that we saw, well, basically that's pre-COVID unemployment rates. So in February of 2020, the unemployment rate was 3.5%. So we're returning to a normalcy of.
That's not a bad economy, and that's not a recession.
That's healthy. Yeah,
it's very healthy.
It's really good.
So while we expect volatility, we expect this volatility to continue throughout this year, particularly because the news media is driving it and because it's a political year. And we believe that the leftists in the news media, they're trying to crash the economy, and that's what we believe politically. But always in a political year, there's a lot more volatility than normal years, and this is going to be as much as ever because of the volatile political situation that we're in.
That's true. And just as a reminder, market volatility is normal no matter what year it is. And we have
show them this chart. This
another illustration that's really interesting that shows in the green, it shows at any point of time how much the market was down throughout the year.
In each year.
And
then the blue bars up above are the actual total year return. And you can look at a few of these examples and, just show them some different examples of, for instance, in 2020, during the year in 2020, during frankly, a very brief period of 5 weeks in 2020, right during all the fear mongering of COVID for when COVID was first coming out, the stock market went down 34% in 5 weeks. 5 weeks. But for the whole year of 2020, it was up 18%. So in order to get those great returns of 29, 18, 32, etc., you have to be willing to tolerate the downs. Even in it looks like it was the year before, in 2019, the stock market was down 3%, but during the year it went down 19%. If somebody had sold when it was down, they would have lost 19%, rather than only losing 3. So the key is now is not the time to sell. Now's the time to buy, and we're going to talk about some other things, about some strategies here in a few minutes.
Yep, and that I think is a good way to bring us to our next point, which is what wise investors should absolutely not do during market volatility or market downturns. And the first one of those is to panic sell.
Yeah, you don't want to panic sell. You don't want to follow the herd and panic sell. Cash is not a good place to have during periods of high inflation. I've said in some webinars before, I've run across a number of clients in the last year that have come in and told me they have huge amounts of cash in the bank. It seems not huge, but lots. Like 100. I have $100,000 in the bank, or I have $200,000 in the bank. What should I do? Well, don't leave it in the bank. Either buy something or invest in the stock market or something, but don't leave it in the bank, because that $100,000 that you have sitting in cash making nothing right now is going to only buy you $90,000 worth of stuff a year from now. So you need to either buy stuff or invest the money, and we'll be talking about that in a little bit. Here's a quote from the Oracle of Omaha that we were talking about earlier, Warren Buffett.
He says, people who hold cash equivalents feel comfortable, but they shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. This is a quote that's true anytime, but especially during a time that we have really high inflation like right now.
Absolutely. So cash is not a good place to have your money during high inflation, and trying to time the market, trying to get out and then thinking that you're going to get back in when the market goes up, it's a myth, and it doesn't work. And I want to show everybody a little, just draw it on a chart here. If I can get this where the camera can see it. Can you see it okay? All right, here's my great chart. We get another.
We had to practice because
we had to practice.
We have to do it opposite because of the mirroring of the camera.
Do I have to turn this way? There we go.
That's good.
So if this is a chart of the stock market, and the stock market's going along, and then there's a downturn. And there's a downturn like this, like we're in right now. What happens is people get to where they just can't take it anymore. Some people panic. People that are watching the news too much or watching their accounts too often start freaking out. Hopefully none of our clients, or not very many of our clients, have done that. But at some point, they like let's say right here, they say, I can't take it anymore, and they sell right here. And then the stock market goes down a little bit more, and they're thinking, boy, that's a good thing I got out when I did. I didn't lose. I only had lost 10% or 20%, and it went down another 5 or 10%. And I'm a genius because I got out when I did. And they're thinking that the stock market's going to keep going down. But at some point, the stock market turns around. It's called capitulation. Enough people have sold, and all the people that are going to sell sold, and then the opportunists come in and buy. And so then the stock market starts going back up. And as it's going back up, this person that sold here is thinking, let's say right here, they're thinking, well, I think it might be going to still go back down. And so I'm not going to buy. They're not willing to buy then. Their idea of selling here was to buy at the bottom. Sell here and then buy at the bottom and take advantage. But they don't have the courage to do that at that point. So then the stock market goes up and they don't buy here. Then it gets back up to where they got out, and they think, oh, well, I'm going to wait till it goes back down again, and then I'm going to buy, but it doesn't go back down. Instead, the stock market, and this is what happens, it keeps going up, keeps going up, keeps going up, and they end up buying here much higher than when they sold. And they were better off had they just rode it out and come back up. And I can tell you that this is proven with studies over and over and over. And I can attest to it with my experience. I should bend down to the camera. With my experience being in this business for 27 years, almost always when people panic sell and get out of the stock market, when they are willing to get back in, the market is higher than where they got out.
When they're comfortable enough, yeah.
Yeah.
To get back in. And there's, like you said, there's plenty of studies on that, and I'll link that like in our YouTube video and on our website to some of those studies. But one in particular that I found was really interesting was that Putnam did a study, and it was, they had done it over a 15-year period, and the 15-year period that they did it included the 2008 financial crisis. And they found that if somebody who had been invested in that 15 years had missed out on just 10 of the best days of market performance days, and it got worse if there was more days that they missed out on, but only 10 of the best days, they had lost almost half of their account value compared to if they would have just stayed in and rode the ups and downs. And part of the reason the market timing fails is that usually the best days of the highest growth in the stock market might be back to back with some of the worst days. And so if you think that you're somehow going to have some kind of crystal ball to be able to time that right,
most people don't have the courage after the market goes down 3 or 4 or 5% in a day. Most average people don't have the gumption to go ahead and buy the next day. We have a number of clients that do that and that are doing it right now, but most people don't. And so if the worst thing that an investor can do is to make investment or financial decisions based on emotions. And the two emotions that kill you are fear and greed.
and that brings us to another quote.
Quote from who, Jesse?
Warren Buffett, if you could
Again.
guess. Whoops.
Hmm.
Well, we're going to share this one because this one applies as well. If you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. If you're not willing to ride the ups and downs of that stock, if you don't think it's that valuable, that it's not going to, that its true value isn't going to show outside of the ups and downs, don't be invested in it. Oops. Okay, so,
Are we here?
mhm.
Okay, so the second thing you shouldn't do is to watch the news. Certainly don't watch it all day long. Used to be, you know, people read the newspaper once a day, maybe watch the evening news, and that was the end of it. But now we have news available on our phones, on TV, at our fingertips all day long. And the people that I see in my life that are the most nervous are the people that watch the news all the time. They're nervous because of what's going on politically, and they're nervous because of the stock market, because the news media is selling fear. Well, the truth is that these companies that you own broadly on the stock market are making money. Their sales are healthy. Their earnings are very healthy. And the truth always eventually comes out. But the news media, like I said, thrives off of fear. One of the main kind of financial news media, at least on TV, is CNBC. And every so often they run, or periodically over the years, over the last whatever, 12 years, they've run a special called Markets in Turmoil. They title it Markets in Turmoil. They've done that, what, 100 times?
Over 100, yeah.
Over the last 12 years. And this chart is showing what the returns of the S&P 500. S&P 500, remember, is the 500 largest companies on the New York Stock Exchange. This chart is showing you the total returns in the next year following the return for the next year following one of these CNBC Markets in Turmoil segments. And there's 100 times that they did it. And the average one-year return after they tell everybody that the markets are in turmoil is 40%. average over 100 times in those 12 months periods. And here's the other thing that's a kicker. Out of those 100 times that they did the markets in turmoil specials, every single time, 100% of the time, the next year, the next 12 months, the markets were up. So they don't have a very good track record, do they, Jesse?
I'd say no. And then our last piece of advice would be not to watch the stock market or track the value of your account every single day.
Nowadays, everybody can do that. You can do it on
Yeah.
your phone. You can, you can see it through the day on your phone. You can look at your account on your phone. You can look at individual stocks or funds or whatever all day, every day. They'll just kill you. They'll drive you nuts because it's going to go up and down, up and down, up and down. And when it goes down, you're going to be sad. When it goes up, you're going to be happy. And if there's a period of downturns, you're going to be sad a lot. And why do it? Because you weren't planning on selling today or
Right.
tomorrow or next week anyway.
So the
Leave it
value
alone.
of it, the up and down value of it doesn't matter that much on a day-to-day or even week-to-week basis. The up or down value of it is, what it's going to be in 10 years or 15 years, which doesn't really have to do anything with what it is on a
Correct,
day-to-day basis.
correct. So some proactive actions for people watching this video or anybody that matter, friend, relative, whatever that you're in contact with, some proactive actions today with these market downturns that we've experienced so far this year. We have 4 of them to talk about. First off, it's an excellent opportunity to buy. And the savviest investors and clients that we have are buying right now. And again, we have another quote from Warren Buffett. I'll tell you how to become rich. Close the doors. Be fearful when others are greedy, and be greedy when others are fearful. That's the way Warren Buffett is. He invests rationally, not emotionally.
Yep. And these are all steps for rational, wise investors.
Right, right. And one of the kind of characteristics that I personally have is I don't panic. I just never have. I never have been a panic kind of person. I try to think. When I'm in a crisis situation, I don't panic. It's just something that God gave me, I think, and I've kind of learned, it's God-given and learned through my experiences and stuff. And I'm not panicking now, and I'm urging and trying to counsel you not to panic too. Another proactive action to take advantage of this market downturn, this is a great time, if you're financially able to convert traditional IRA money to Roth. A traditional IRA has a certain amount of money in it, and we look at that money and we look at our account, and we think, well, that's all our money, but it's not. Part of that money is an obligation to pay taxes on. So let's say it's a $1 million IRA, and you think, well, I have $1 million. Well, you don't have $1 million. You have $1 million IRA, 300 or 400,000 of which you would have to pay to the federal government if you cashed it in. Or maybe to make it a little more reasonable for a conversion, let's talk about $100,000. $100,000, because you don't have to convert an entire IRA to Roth, you can convert parts of it. And we had some people do this back in the downturn of 2020. Some people right at that bottom took advantage of that and converted IRA money to Roth. And so let's say they had a $100,000 IRA, they converted it to Roth. It had been, before the market downturn, say $130,000 IRA, went down to 100, they converted it to Roth. They caused themselves a tax liability of say $30,000 federal and state that wasn't due until April 15th of the next year. So it was a year away yet. And then when the market recovered, their account value was all tax-free. You got to leave it in for 5 years. And this is certainly a little bit, there's a few ins and outs of it, but you need to have money from outside the IRA in order to pay the taxes in order for it to work right. But this is a great time to convert traditional IRA money to Roth IRA rather than leaving that money sitting in the bank losing buying power that you would pay the taxes on. And then we already mentioned a third proactive action is not to panic. And then the fourth is to focus on the long term. For most of our clients that have money in the stock market, you should anyway, if you have money in the stock market and these types of investments, they're long-term investments. There's going to be market fluctuations. And unless if you can't tolerate market fluctuations, you shouldn't be invested in the stock market. But if you can't tolerate market fluctuations, you're going to be stuck at earning relatively low interest rates of 2 or 3 or 4% at the best. You know, and with this inflation and rising interest rates may go up, so, you know, to where they're really attractive again. But after taxes and inflation, fixed interest investments always lag behind it. You always lose buying power after taxes and inflation with fixed income things.
So we're going to talk about some actions that nervous investors can take to reduce their potential downside risk. So we don't blame people for being nervous during this time. And it's not about, it's whether or not you act on your nervousness or act on your fear that makes you rational or irrational. Irrational people usually act on fear, and it usually causes them to make mistakes. But rational people can feel fearful and still make rational decisions. And so if you're someone who feels nervous or feels really, really uneasy when there's market downturns like we're experiencing right now, here are some things that you can do.
One of them is there are products out there that you can buy that offer insurance guarantees protecting your lifetime income and guaranteeing you lifetime income and protecting your account value for your heirs. And if you think about what, for instance, most money that people have invested with us, a lot of it is retirement accounts, and a retirement account is kind of like a milk cow. You're growing that milk cow, and then you start milking the milk cow in retirement, taking some income off of it, in which case, if you had guaranteed income, that would be helpful. And then you want to leave the cow to your kids or your heirs when you die. So there are guaranteed income benefits and guaranteed death benefits that are available with some of these products through insurance companies, where you can still be 100% invested in the stock market, and you're going to get the returns of the stock market less the cost for the insurance, which might be 1 or 2% or slightly higher. But it's kind of like homeowners insurance on your home, in that you end up paying a little bit of money for that insurance, but it gives you peace of mind. So that's one thing. Another thing that we do for our clients that are invested in equities is look at the broad world global economy and think about if we're going to be in the stock market, which I believe is the best place to be invested especially during places of times of high inflation. It kind of goes to, do you think that capitalism is expanding or contracting outside the United States? And I would think that most people, when I've asked that question, they say it's probably contracting, especially because of the stuff that the governments have done because of COVID and whatnot. Capitalism's contracting. So we're sticking with the United States. We're staying in the United States, no foreign investments. In order to try to reduce risks, we're sticking with mostly large companies, no small companies, and a very small portion of our allocations in medium-sized companies. And then as far as growth versus value, we're leaning a little bit towards growth, also leaning a little bit towards more technology, because we're in a technological revolution, and that's where the most growth is gonna be. And it's impossible to time the market. The key is to diversify, not to bet the farm on Tesla, or not to bet the farm on what the latest stock that's in the news is. To diversify away individual company risk by investing in a lot of companies. one thing that some people do and some people are feeling like doing in these times is to invest in gold. There's a lot of ads on TV for buying actual gold. You can buy gold in the stock market with the symbol of it is GLD. It's an exchange traded fund that owns actual gold, that some of our clients have had us put a small portion of their money in GLD in order to try to help hedge against inflation. Remember, there's 3 best investments in times of high inflation. It's companies, because if you think about what inflation is, it's the rising cost of goods and services. Well, what better hedge against inflation than to own the companies who are producing and selling the products and services who are going up in value? They'll go up in value too. Secondly, income producing real estate. That's a great hedge against inflation because both the value of the real estate will go up with inflation and the rent or the income from the real estate will go up with inflation. And then finally, gold. And I don't like gold as much as I do the real estate or the companies, because gold doesn't produce any rent or interest, and it doesn't produce a good or a service whose prices are going up.
So we've gone over a lot of information. We know that was probably a lot to digest in a short amount of time, and we've gone a little bit over time, but we're gonna look at any questions, and if you have any that you want to type in here last minute, we'll address those. We've got one question.
It's kind of an interesting question. Has there ever been an administration so bent on making people dependent on the government? How will it affect the economy? And that's kind of a bit of a statement rather than a question, but no, I don't know. There hasn't been an administration in my lifetime more bent on making people dependent on the government. But my opinion is that they're not going to be successful. Politically, I feel like everything that the Biden administration, well, it's not politically, I feel like, but everything that they've done has been a failure, and they keep messing things up and making big mistakes. And people are waking up to what the government's trying to do, and they're coming out in droves to vote for conservative candidates. And I think that we're going to be safe because of that. I think that the election in November is going to be an overwhelming rejection of socialist and communist ideas, and a win for people that love freedom and capitalism in our country. So anyway, but
I think that's our only question. So we're gonna close up here.
Wrap it up. You please give us a call if you would like to talk to us. You can call us at the office at 402-421-2626, or drop us an email at bob@bobbenny.com or jesse@bobbenny.com. And
we want you to be able to enjoy your summer and enjoy your retirement and not worry so much about what's going on in the news or in the stock market. So we just want to remind you that it's our job to watch that kind of thing.
Right.
And it's our job to worry about that for you, and take care of that kind of thing for you. So we don't want you to worry. If you feel worried, call us. We'd rather have you call us, and we'd love to talk to you if you're worried than just have you sit and be worried about it. So
thank you very much for watching our webinar, and God bless and have a great day.
Thank you.